All right, let us get started. Welcome to our November 2020 webinar from the team at Altos Research. I'm Mike Simonsen. I'm the CEO of Altos, if you don't already know me. We do have on the call today a couple from the Altos team, couple people from the Altos team to be able to answer questions in the chat, share links. So if you're like, hey, where do I get that thing that Mike just referred to? Ask a question in the chat. We're trying to monitor those and get those answers and resources to you as we go through. So feel free to use that chat. You got a bunch of people on the line today and a bunch of people still going in. We'll plan to talk about the data. We're going to look at some live data. And if we even have some time, maybe we can do some specific Q&A. Usually after I wrap up, I will do Q&A at the end. If there are specific questions or ideas or things you want to share, I can stick around a little bit to do some of that. So feel free if you've got questions, or if you asked a question during the session that I didn't get a chance to get to, we'll see what we can wrap up with. I will try to aim for about 45 minutes with these, and then we'll see how much we get through. So today, normally I would call this an agenda slide, but it's really the ideas that I want you to take away with you today. What we're going to do is, look at the current market, where we are before the holidays, how the year is shaping up. I'm going to try with each of these data points and the trends to share what we already know about 2021, all the prices and supply and demand indicators. And then we're going to spend some time, I'm going to try to spend some time working with questions that we're hearing buyers and sellers ask right now. We're going to look at some of the local data and use it to answer some of those questions and help you learn about how to dive into the Altos reports so that you can answer those with confidence and with insight for people making decisions right now. So that's how we're going to proceed through the call today. If you have questions that you, for example, are hearing clients ask, buyers and sellers ask, that for maybe things like should I take action, or whatever the questions are that they may be that you're hearing right now. I'd love to hear what you're hearing. So share those in the chat for us. We'll try to get to them today. And if we don't, they'll be good fodder for us for future conversations. We can really help you best communicate with home buyers and sellers right now. It's a crazy time in the market. And so everybody needs to know what's going on, and that's what we're here for, and that's what the data is for. So let's dive into it. Before we do the data, I would want to make sure that you all know about this brand new free ebook that we've published at Altos. It's a comprehensive guide to the market data, and it'll help you talk more confidently about the stats and how to forecast what's coming. The book dives into key stats to watch, how to talk about the trends, how to answer buyer and seller questions, which we're going to do a little bit today too, but the book is where we've got them all written down. How to use the data in your marketing. So if you are a realtor and you're interested in using the data to work with your buyers and sellers, then you should go download this ebook right now. We will share this link in the chat during the session. It'll also be like in the follow-up email that we send when we're done with the recording. It'll be in the comments below in our YouTube page. So this video and all our others are in our YouTube page as well. So download that ebook right now if you want to use it in your data. As I mentioned, use the chat box to ask questions along the way, and we will take it from there. Okay, let's dive into the data. I want to start with the supply side of the supply-demand equation today. Total inventory of homes for sale. You know, if you've been paying attention to the work we do or anywhere in the country, you know that we are in a crisis of low inventory, a shortage of inventory. The current total inventory of single-family homes in the whole country right now is down to 529,000 this week. You can see we're 41% lower than last year at this time. And we're in November, in the time of year when each week, you know, through the holidays, we'll go through Thanksgiving into December, peak of winter, we got Christmas and New Year's. Each week, we're going to have fewer and fewer homes for sale. A couple, 1% to 2% fewer homes on the market each week through the end of the year. And so what's fascinating is, like, we're going to fall below this 500,000 line in just a few weeks in December. So, you know, we know that we're in this crazy shortage. And what we already know for 2021 is that inventory of 2021 is going to start at crisis low levels. So for those of you, for example, who have buyers who've been like waiting on the sidelines with cash, waiting for bargains, the smart question to ask them is, how long are you going to wait? You know, we're going to start this year with less than half the inventory we need. That means that we're going to start the year with, you know, the same supply demand dynamics that made 2020 so nuts with price appreciation. So supply's been crazy restricted. We're starting the year going to be crazy restricted. And during the year, there are only a few potential catalysts that might change inventory, this trend of inventory. So the catalyst that might make this change happen, if interest rates climb, it may be a trigger to get more properties on the market. You may have heard me talk about this previously. So our shortage is actually a function of a decade of ultra low, ultra cheap mortgages. So money is so cheap that it's been a really good time to hold real estate. It's really cheap to hold real estate. The cost of the money is so cheap. So more and more over the years in the last decade, when you buy a new place, more people hold on to the first home. You hold on to it for income, for a rental property. So the average mortgage rate in the last 10 years has been 4.5%. And the few times it climbs over 4.5%, we can see the market slow way down and inventory climb, demand start to fall. That was, for example, the second half of 2018. So in 2021, if rates climb to or above 4.5%, you're going to see the market slow, and some of these homes will start to feel expensive. They'll feel expensive to hold. There will be more listings. So interest rates are the most critical factor we should keep our eye on to understand whether this inventory trend is going to start changing. The second factor that we got to keep our eye on is if the economy tanks more broadly in 2021. We know that right now employment is clawing its way back. You know, it feels like a new round of stimulus package will happen. We know there are good advances on vaccine and treatment. So, so while we're not out of the woods on a risk, specifically to larger companies in employment with larger companies like banks and transportation and energy companies have been laying off people. It sure feels like as of right now the recovery momentum is in our favor. So that makes me feel mostly bullish on this topic. But if the economy tanks in 2021, there's a risk. That will be the change. It could be a trigger change for our active inventory problem. The third way that we might get more inventory in 2021 is if the policy shifts away from protecting the homeowners to, for example, favoring lenders, maybe in this pandemic crisis period. All the policy during the pandemic has been on helping homeowners stay homeowners. And so we've got the mortgage forbearance program. The current date on that from the CARES Act is April. That'll be the year anniversary. What's interesting is that at that time, there are people who have not been paying their mortgage who are going to have to start. The other thing that might happen is they could policy-wise extend that. And if it looks like there's going to be a big wave of people who are in trouble, you could imagine that they would extend that deadline. The other thing, though, that's fascinating is that the number of people in forbearance is falling every day. People are paying their mortgages, they're getting current, they're maybe selling their house. They don't want to lose their house because it's a really good time to keep your house. You got cheap mortgages and a rising equity, like you're making money. So as a result, no one wants to trigger the crisis of a bunch of distressed properties coming to market. And it's also the consumers don't want it either. So they're taking the action. So in our view, it looks like that April deadline is going to be less and less likely to be a catastrophe. All this adds up to shortage again for 2021. If we look at the new listings volume, so this is the total number of homes getting listed for sale, newly listed each week. After our pandemic time, and you can see this pandemic, the red line here in April and May, when we had our everybody pulled back from listing houses. As the market heated up and was hot for the year, that hot market pulled more new listings out. And so as a result, since August, we've been in, or even July, we've been in normal range of new listings coming to market. And what that means is, there are new listings, there are people who are testing the market with pricing. And so far, actually, they've been getting their pricing. So it's people like, well, I've been thinking about selling my ski house for years. Let's see what I can get for it. And as a result of the hot market, you have people testing what they get. Those listings come to market. That's actually helping our supply scenario. I have a Silicon Valley colleague who recently sold their gorgeous home in the area into the hot market. And in their case, is like, they want to stay on the sidelines with cash for a while. They have a bearish view on the economy for 2021 for long-term implications. And so if the economy tanks, they want to be in a position to get a bargain. So those listings are indeed happening. And the new listings volume is likely to stay healthy into 2021 here. So you can think about your marketing to potential listings as there are people out there who may want to test and see what they can get in a hot market. One actual caveat here is that these listing volumes are actually way lower in recent years than they were even like 10 years ago. And this is, as I mentioned in the previous slide, this is like the origin of the inventory crisis. Because rates are low, more and more people hold their first house when they sell. or when they move. So they hold it for income. And so you end up with people who move twice and now have 3 houses. And this phenomenon leaves us with a material fewer homes for sale each year. Everyone in the country has ultra cheap mortgage and holding costs are really low. So supply, going to keep our low supply with some good, news of people testing the market and trying to get home prices, their price for the home. Let's switch to demand. So one of the lessons of 2020 is that demand wasn't just about the pandemic crisis. Demand in 2020 is actually really the first year that the millennials started making their home buying mark. Up till now, the millennials have been a bearish narrative. It's like they have too much student debt. They are waiting later in life. They're not getting married. It's been a bearish message narrative about millennials and home buying. But what we're finding is that they're just now reaching their peak buying age and peak earning age. So, we're looking at a decade of demand, home buying demand for millennials. This is a population chart of the US. And what you can see are that the boomers in their 60s with this peak of population here, the Gen X trough, fewer of us in our 40s and 50s. And so we had, decades of home buying. We had the mortgage crisis here, and now we're emerging out of it. And we have the biggest population boom ever is coming. And those people are coming into peak earning and peak home buying years. They're just now in their 30s. And we're not even to the biggest bulge in that market yet. So this is a broad scale multi-year demand for homes. We've been underbuilding for the last decade. We've been building for a Gen X population, and we've got millennials ready to buy. So when we're thinking about, what 2021 looks like, demand, the important message here is that demand is not just a COVID demand. Demand is a across the market, big population boom driven demand. All right, let's look at days on market. So currently we're at 109 days on market. So really, this is where one of the places where you can really see how the crazy year of 2020 was different from the last 4 or 5 years. This is average days for the active properties, all price points across the whole country. Many markets super hotter, many much hotter than this, but a lot of price points may have 200, 250 days. So you can see we started the year at about 140 days in the market. This is the dark red line here. The pandemic time, we started in March, and we were actually 2020 was already on its way to be a hot year. Low rates, high demand from millennials. And then we had our pandemic, our first lockdown correction by May. And then all the rest of the year, our demand has stayed so hot that time to sell a home has been declining. Normally, the market demand peaks June 30th, starts to cool off in the third quarter, takes longer to sell. We have fewer new properties coming in. There's less, the turnover is slower. And so time to sell gradually increases through the third and fourth quarter. We are just now in November seeing this turn of the corner like we would normally see the first week of July. So we will see days on market climb through the end of the year. And then in January, we'll get a reset. But what it tells us is that 2021 is starting way hotter than normal. And we already know that. And so we know demand, supply is low, demand is already higher. And therefore, that's likely to support prices and the price increases that we've been seeing throughout the whole year. So, as we look at it, the indicators are about another really strong price appreciation year for 2021. When we talk about, I often talk about leading indicators in the Altos data. One of the most powerful leading indicators is percentage of homes taking a price reduction. And we'll dive into a couple of markets where we can look at the local variations on this. But you can think about price reductions in this band, this 30 to 38% band, where about a third of homes are overpriced and take a price cut before they sell. And this is looking the past 90 days. How long has it been since they've taken a price cut? And so every year at this time, price cuts accelerate in the third quarter. We want to move things before school starts, or let's get it out before the holidays. And they maximize right now in November. Then stuff gets withdrawn, and so there are fewer things on the market and lower price. So price cuts fall through January. We start listing new properties January and February. Then in March, now we've got the springtime and a few things start adjusting and that number climbs. So this is our normal seasonal pattern. It's like clockwork, except for this year. So in 2020, we tried to turn the corner. We're climbing a little bit in price reductions. Right now, we're at 26.3% price reductions. This is like the normal hottest part of the year. And so this is another signal when we say what's going to happen for 2021. We know that the homes that are getting listed now, the ones that are testing their pricing, like, can I get this much for it? We know that in general, they don't have to take a cut. So about 35% think they're overpriced, but only 25% have to take a price cut. Like, that is a strong signal for the organic levels of demand in the market. That means, for example, that that prices at the houses on the market now, if it doesn't get an offer and it takes a price cut in December, then it gets an offer in January and the transaction closes in February, you can see that price cut is telling you where the transaction prices are going to be in the future. And what this tells us right now is that the current levels of pricing are going to hold through the new year. Like, we have enough demand, we have tight enough supply that pricing is going to hold through. So this is a really bullish indicator to finish the year on in terms of price appreciation for 2021. So as we look at the leading indicators, one of the questions of it being, when's this going to change? The leading indicators as of right now have us looking at a strong market for the rest, into 2021. And that brings us to pricing. So we talked about supply, we talked about demand, and let's talk about prices. So the median home price in the US right now is $349,900. You can see in the dark red line, we are slowly ticking down. Normally each year peaks June 30 and then starts to recede a little bit. This is because the best inventory is happening in the spring. We start, as I mentioned, if it's still on the market in August, you start taking a price cut, and You want to get ahead of it before school starts. We have all those phenomenons that bring the price of the properties on the market down week over week through the end of the year. Then in the second, third week of January, we start to get new properties on the market and the prices climb. So you can see this easy, normal seasonality. This blue dot is, last year, each year at this time. And we could see for example, in 2018, when mortgage rates climbed, you had a steep pullback in prices towards the end of the year. Like you could feel it. And if you remember the headlines at the time, the headlines noticed it. Right now, not very steep pullback. This is another indication of the strength. And remember, these homes are on the market now. They don't feel the need to take a price cut. Therefore, they're going to transact in December and January at the elevated prices. The blue line on this chart is the median price of the newly listed cohort. And this is the cohort of homes that got listed every week, each week. And where are they priced? This is, as we like to say, is a really powerful example of a wisdom of the crowds. It's the economic term, meaning the sellers in aggregate and the listing agents know exactly where the demand is. They know how many people, they know that the house down the street had 29 offers. They know that they've got buyers coming out of the woodwork. They know that they can price their next listing a little more aggressively. And so you can see that. We could see that immediately in April and May of this year, that the new listings prices climbed really fast. And it's actually that time of year May is when the new listings start to back off, because we know that the peak of the transaction is going to happen in June. And so if I'm coming in June, I'm already missing my little window. So prices come back a little bit. This year, not so much. They stayed elevated all the way through. We should expect new listings price to drop each week through the end of the year now. Like if you're listing your house at Thanksgiving, it's not because you're trying to maximize your price for it, right? So we expect this to come back. We're right now at 309.9, and you can expect the new listings to drop back, under 300. This is we started the year at 250. There are 2 weeks, the first and second week of January, before the prices start to climb with the new stock at the beginning of the year. You can see at the beginning of 2020, before the pandemic, 2020 was destined to be a really strong pricing year anyway. And that's because rates are low, demand is high, millennial demand is high. Like we already had the mix in place. You can see in 2018, I've mentioned this a couple times. So beginning of 2018, had a real steep climb in the new listings, and then rates started climbing, and the new listings price pulled way back as people grew, as mortgages are more expensive, the house becomes more expensive, monthly payment becomes more expensive, and the price gets affected very quickly. So as a leading indicator for 2021, the price of new listings is very bullish right now. And so that you can imagine that we're going to have another year of strong price appreciation. As bullish as I am on the market, and as much as I, like to read what the data is telling us, it is important for us to make sure we understand what's happening with the millions of mortgages in forbearance. Those are the people who have not been paying their mortgage for 8 months, 9 months now. And that, as of right now, the forbearance program ends in April. And the question is, what happens to those? Well, so I have this seesaw balance of factors that I pay attention to. On the positive side, we know that homeowners, even if you haven't been paying your mortgage this year, have been gaining equity rapidly. So if you bought your house more than a couple of years ago, you got lots of equity. And so if you have equity, you don't walk away from your mortgage. Maybe you sell, but you don't walk away in a short sale. There's no short sale or a foreclosure. We know that more than 50% of the people that started the forbearance program already out. They're out and they're on. And they've either reemployed or they realize that they've got a really good deal with their current mortgage and the current market, and they don't want to be at risk. We know that everybody has ultra low rates, so it's really affordable time to own. So there are still 2.8 million people in forbearance, but that's down from 6. So we have to pay attention to these. The sum here is that as of right now, the data is telling us that we are unlikely to see a big wave of foreclosures or distressed sales in April. But it is important for us all to keep our eye on that, to know for sure, to see if any of those signals are changing in the 4.5 months until we really hit that time. So there is risk there, and we shouldn't be cavalier about the reality of that risk. It feels like we're at a pretty solid place. Okay, so let's summarize some of the themes that we've said for 2021. So when we're predicting what's going to happen in 2021, as of right now, it looks like record low inventory is likely to continue all year. We know that the millennial demand is there generationally, big population demand. We also are already starting to hear new Biden administration plans for stimulus. So one of the things on the table is a first-time homebuyer tax credit, $15,000. We know that in 2009, that single-handedly reversed a crashing housing market. Major impact at that point. So it could be we're sitting there, we've got this demand, and we're adding more stimulus on top of it in 2021. We know that the April forbearance window is unlikely to be catastrophic, but there's still a lot to be resolved there. And the risks that we're going to keep our eye out for: rising interest rates. So if they rise, for example, like they did in 2018, then you'll see demand back off. You'll see inventory tick up a little bit. My expectation is it's probably got to be an extended multi-year climb of rates before we see a broader shift in available inventory. But rising rates are where we are most sensitive in this market. All we know is 3% interest rates now, so 4% is going to look expensive. And then the other risk that some people are, I hear people still focused on, and I think it's at least important for us to keep our eye on, are if we have a renewed recession, if we have a broader recession, we have bigger impact from employers, the bigger companies that have not been able to recover. So those are the big 4 themes to keep in mind for 2021. Overall, very bullish. All right, let's switch for the next 10 minutes or so to go into addressing home buyer and seller questions. There's a couple that come to mind. How do I know if it's a good time to buy? Or is it a good time to buy? People are worried. They see a hot market and they do I buy into this? Is it the bubble? Is it too late? These are all, is it a good time to buy questions? And we'll look at some of the data to see how we might answer that, how you might look at your data, how you might frame your local market into that discussion. How fast do I need to act? Or for my friend who, wants to be the vulture and swoop in and get a bargain, like, do I need to act quickly? Can I lowball? So we're going to answer that one. And then how about when is this going to change? Like how long are we in this market? So we're going to look at some of the leading indicators and some of the timing on that. So let me switch here to here and here, and I'll share here. Okay. All right. So how do I know if it's a good time to buy? I just pulled up a bunch of reports this morning. So let's look at some data. Let's start with Charlotte, North Carolina. How do we know if it's a good time to buy? So we know that it is a strong seller's market. The demand is high. We can look over here and see that, for example, the price per square foot is been climbing for the last several months. We know that inventory is falling. We know that, interestingly, the percentage of prices with homes with increased price is climbing. These are all indicators of strong demand. So price increases, these are flips. These are things where marketing changes, where a house was listed and you pulled it off the market and then you relisted it at a higher price to shift a demand window, for example. Each of these indicators is bullish. And the reason they're bullish, they're showing a lot of demand, is because it's a good time to buy. With rates as cheap as they are, the holding cost, the affordability on homes is really good. And Charlotte is just one example. You can see if we look at pricing over time, Charlotte is normally this time of year in November and December. That's the low part of the year in terms of pricing, right? You peak in May, June, and then we pull back for the fall and we cycle again. But we're in Charlotte, we're at the peak of pricing right now. So this is what it's talking about. This is what we're looking about, why it's buying time for homes. And you can see it reflected in the houses. And I talk about this data, Charlotte's a big inbound immigration market. It's growing. It's city. It's a strong economy. But these phenomenon are true across the country and across price points. I grabbed Kalamazoo this morning, and we can see that Kalamazoo is in a strong seller's market. Kalamazoo, Michigan, we have, we can see, this price range in Kalamazoo, similar kind of pattern. Normally we'd be, are peaking in the summer and trough now, but we are actually up this year in December. When we look at the price ranges in Kalamazoo, you can see things a lot. You can see exactly where the demand is. This is an affordable market, 20 days on market at the $150,000 range. It takes longer, at the bigger land, the higher price points. But you can see exactly where people are buying in Kalamazoo, and exactly, especially when you're working with a buyer and seller, you have that ability to communicate with them. Look, we're buying in the highest demand, and there's a reason, because this is such an affordable property. On the west, Boise is one of the examples of what we've called the Zoom towns. So the Zoom towns are the towns that are where we can move to have a nice quality of living, because we can work remote now. These are also places like Truckee and in the mountains. It's Palm Springs. I'll show you a few more of these too. This is Boise. Boise is off the hook. in terms of the market action index. Remember, the market action index is our at a glance indicator of how's the market. That means it's the supply versus demand. And so the tighter the supply and the higher the demand, the higher that number goes. So super hot. It's November, and it's never super this hot in November. We can look at prices in Boise. Boise's obviously been a growth market for several years, and you can see that what's really happened in pricing in Boise. We can see that the market really over the last several months, the market action index is climbing nicely. So it's getting strong, getting hotter there. I mentioned the price increase number. This is fascinating. So in Boise, we talked about how the percentage of properties with price decreases is a leading indicator for where homes are going to transact in the future. If it's on the market now, and normally 35% need a price cut, but only in Boise, only 17 have taken a price cut. In fact, let's look at this over time, price decreases over time. So we can see here this broad trend. Normally this time of year, about 40% of the homes in Boise taking a price cut. Right now, down to 22. Or if we look at the weekly number, it's even lower, it's at 17. So you can see this amazing demand in Boise. And so these are people, moving out of Seattle and San Francisco and California and buying very quickly and without needing the price cuts on those properties. Amazing. The price increases in Boise is at 21%. So these are homes that were on the market. They got bought, flipped, back on the market at a higher price, or ones that didn't even flip, they just withdrew, did some price changing and relisted to get a stronger price. This is super high demand because it's a really good time to buy in Boise. It's an affordable market. You come out of California or Washington, it's an affordable market. Rates are super low. You can get great stuff. And so that's why the demand is being driven there. Okay, here's what's interesting. Let's look at San Francisco. So San Francisco is one of the few places in the country where, we've seen demand weaken. And it was certainly the story. Everybody's heard the story. People are running out of San Francisco and New York. So I thought I would spend a minute today to say what's actually happening. What's fascinating is, okay, so we can look at, this is condo inventory in San Francisco. So here's our multi-year 500 homes for sale. And all of a sudden this year we're at 2,000. We're at 1,500 homes. We're up, 2-3 times what we were. It's real clear. What's fascinating though is that this is really, we're still actually at a kind of a balanced market. How can that possibly be? Well, San Francisco is normally at a crisis shortage of inventory. So normally there's 800,000 people and only 500 condos for sale. We can look at Fort Lauderdale, which has only got like 180,000 people, and Fort Lauderdale inventory. Fort Lauderdale got more condos for sale than all of San Francisco. So what that tells you is that San Francisco, in this crazy time where a lot of condos come to market, it's really only putting it back to a normal place. It's why you actually see transactions happening. You can see days on market is staying relatively low. There are deals happening, and despite what the grand narrative, it's actually not catastrophically bad. You can look at, for example, some zip codes. This is 94105. These are the downtown condos by all the tech companies. You can indeed see price corrections. We are in buyer's market territory. The inventory in this zip code alone is going, from from 50 in April to 200 now. It kind of looks like if we look closely, we're probably at our peak there. That'll start to come back over the new year and reset a little bit. And really, the demand is weakest at buying a $3.5 million condo. But under, at the $1 million range, these things are still happening and they're still moving. So it's just like a fascinating thought. One of the reasons that demand that the market's held up is because rates are so low. People that own and maybe are buying in Boise or Truckee are able to hold on to their current place because it's actually really cheap. The monthlies are really cheap. So that's keeping even more properties from flooding the market. You go just across the bridge to Alameda, still a pretty urban market. And Alameda is just like everywhere else in the country, off the charts. Super seller's market, way tight demand, way big supply. We looked at Fort Lauderdale already. So Fort Lauderdale has as many condos. Little Fort Lauderdale is like 180,000 people, as many condos on the market as all of San Francisco. They take way longer to sell. That's the Fort Lauderdale market. Here's a quick look at Truckee. So we know that a lot of demand went into Truckee this year. All the supply got gobbled up. So this is the Lake Tahoe market from the San Francisco ski towns and summer towns. So, you can look at inventory of homes usually peaks in the fall in Truckee and, at 200-300 homes. And right now, we're at 84. So these are moving super fast, driving prices off the charts. It has ticked down a little bit. The market action index has ticked down just a little bit, but it's now winter in the mountains. And so that is going to happen. Let's look at another Zoom town, Bend, Oregon. One of the questions is that the consumers are like, do I have to act quickly? If I'm buying in Bend, do I have to act quickly? How quickly do I have to act? Well, the way I like to do that is to look in the price range segments, and we can look at the days on market. And so you can see exactly where the demand is in Bend. So to answer the question, do I have to act quickly? Well, the chances are, you're buying a $500,000 home and our days on market is 30 days. Like, you don't get to screw around. Even if you're buying a $1 million home, you only get a little bit more time before it comes on. It's really only at the $2 million homes in Bend where the days on market climbs a little bit. So when you have that question, well, I don't know, do I have to act quickly? The showing this demand in the price range that they're buying is the most effective way to communicate that urgency. We can look at Palm Springs. So another Zoom town. Look at prices in Palm Springs this year. Like multiple year, it climbed a little bit, but then boom, where the demand comes. Let's see, where are people buying? Anything under $1 million is going in 40 days. Do I have to act quickly? You bet. If you're going at 2.5 million, you have a little more time to act. I was looking at Hyannis, Massachusetts, Cape Cod, another Zoom town. You can see, for example, prices climbing there. We can see, look at this. Here's our days on market in the price range. $500,000 and under is all going super quickly. The real expensive stuff, the $2 million properties, $240. Right? Now you know exactly where the demand is. You know exactly how to frame that conversation. And then let's do one last question real quick, and then we'll wrap up for the day. The question is it going to change? Are we going to, is this market, our price is going to come down? And I picked Seattle here because Seattle is one place where we can see price decreases climbing. So I don't know if you remember Boise. It showed Boise was at 17% price decreases. Seattle, 49%. So there is some indication of price weakness for Seattle. And it's not really weakness. It's still a seller's market. It's still inventory. It's still relatively tight. It's more than last year, but not, out of whack. It's not San Francisco climbing. So the question is, let's look at price reductions over time. So normally the price reductions is in this window of 30 to 40%. You can see here, if we look at Seattle, the little dot here is the annual, is where we are year over year. Normally in Seattle, coming into the fall, our price reductions climb. You could see Seattle peak buying is right here in April, right? Then you buying for the summer, and then price reductions peak in the fall, in December. November, December. But normally price reductions about 50%, 45%. So that means like in the fall in Seattle, it's like we cut our prices a little more to move the home. So we are a little higher than normal. And we can watch if this goes above 50% in December, that's going to be showing some demand weakness that we should keep our eye on for the spring. It's not a ton of demand weakness. As I say, our market action index is still in the seller's market time. Inventory is tight. People are still buying homes. Let's compare that though to price reductions in Dallas. Dallas is at 45% price reductions, but Texas tends to have a higher band than the rest of the country. Texas has generally larger inventory. There are that are on the market more, so there's more competition for sellers, so you end up with higher price reductions as a rule. And so normally this time of year, Dallas is 50% price reductions, and this year they're only at 45, right? So we're down this year in a time when Dallas would normally be higher. So what you want to use is that 35% number I use as a rule of thumb for the national number, but you want to know your local cycle here. And so that you know that Dallas, for example, at 45% is actually higher than it normally is. So that signals no change in the pricing, supply and demand metrics for Dallas for this year. It's going to be another good year, at least through the first and into the second quarter. But then we have, some of those other variables to keep our eye on. And let me switch right back to our last slides here and do a little bit of a wrap up. Wow, we got all the way through the end of the mark. Let me zip down through my last slides. So we got close to the hour. Holy moly, doing a lot of talking. Download the ebook. You can go, there'll be a link in the chat. I'm sure there'll be a link in the description below if you're watching this recorded. Schedule a one-on-one demo. So if you're looking at this data and you're like, oh, wait, my market's different, or tell me about how we're going to work. Like, I've got these sellers, or I've got a bunch of buyers. What do we do? Schedule the one-on-one time so that you can strategize about your local market. And then if you want to keep your eye on the videos for the weekly videos that we're doing, or to be reminded that the monthly webinars come up to do all the in-depth stuff, subscribe to the YouTube channel. So get the ebook, make sure you sign up for a demo to do your strategy on your marketing, and plan for your first quarter, because it's on top of us. All right, everyone, we're going to wrap it there today. Thank you so much for your time. I will stick around for a few seconds here and try to glance through the chat. I know the team has been on, so there we go.